Thanks, SOSV. It's great to be back. I do want to start today with a couple of numbers. If you look at venture capital data from the first half of this year, Sightline says that total investing in climate tech was down 20% year over year to $11.3 billion, down 41% from the second half of last year. Deal count is also falling, and it does seem that Series B and later climate tech startups are having a harder time raising money. At the same time, if we take a look at our planet, CO2 emissions are at or near record levels, land and ocean temperatures are rising, hurricanes are getting stronger, and sometimes it seems that the whole world is either under a heat dome or underwater. So this panel could not be more pertinent to the world today, and I'm very glad to be joined by three excellent venture capitalists. We have Gabriel, Managing Director of Prelude Ventures. Gabriel, say hi.
Hey there. Thanks for having me on. Good to be here.
My pleasure. We also have Mike Schroepfer, founder and partner over at Gigascale Capital. Mike, say hi.
Hey there. Happy to be here.
And last and certainly not least, we have Milo Werner, a general partner over at DCVC. Milo, hey.
Hello.
All right, actually, Milo, I want to start with you because in the DCVC Deep Tech report, you guys wrote something that I thought was both provocative and fair. I'm just going to quote here. In some ways, the current climate tech pullback is both expected and welcome. At 2021 levels, too much money was pouring into companies that lacked the fundamentals they would need to thrive. Valuations went up, couldn't be supported through revenue growth, and now those companies are struggling to raise. Does that mean, Milo, that the current retreat in climate tech investing that I just outlined isn't as bad in reality as it appears to be on paper?
Oh, that's a great question. I mean, just to build that out a little bit, I think we have some massive tailwinds that are supporting industrialization for climate tech. We have this massive piece of onshoring that's happening, starts of new manufacturing facilities in the US are up 10x over the past 5 years. And we have an entire generation of digital native entrepreneurs that are out pulling technology out of our academic institutions and pushing them into industry. So there's this just two huge subsets coming together. I don't think the numbers describe accurately what's happening. I think that there's tons still happening in the climate space.
Okay, so that's actually relatively encouraging. But Mike, I want to get you on this as well. Sightline said that today round sizes are actually healthier compared to what we saw in the 2021-2022 market, quote, mania. So again, is what you're seeing on the ground a little bit more rosy or sunny than what we're seeing in the data?
Yeah, I mean, I've been around since the 90s. So I started my first company right after the dot-com bust and saw the mania going up to the dot-com boom and then bust, 2007, 2008. I've seen sort of them in all. We tend to go through these cycles. I would describe, the 2021, 2022 time as a little bit over exuberant in the sense of, you had rounds going off where someone say, hi, nice to meet you. We're closing on Friday. Here's some crazy valuation. Let me know if you want in or not. That is not the way to run diligence for a company that's going to take 15 years to hit sort of massive scale. And so I think what we have now, what I'm experiencing is a bit more of a rational process where we take some time to get to know each other. I'm not saying months, but weeks. And also a lot more pressure on companies where I've been at from the very beginning, which is, look, you got to be a good business. At the end of the day, people want to buy your product because they like it or because it costs less. There are not many other business models out there. And I think that too many people are sort of building on hopes and dreams and weren't doing enough of, techno-economic analysis and other things, customer vetting to make sure that you could build it there. We're seeing, basically a bimodal distribution is companies that have strong core economics and a strong team have oversubscribed rounds, have no trouble fundraising.
Can I just jump in there, Mike? I think one thing that's really interesting is that we have a lot of capital in the early stage. There's probably 50 early stage investors. And when we look at PitchBook, there's probably $20 billion of dry powder in the early stage. Then you have the industrialization phase, and then you have this growth phase, and the growth phase probably has $125 billion. There's been an enormous number of funds announced kind of in growth. And that's kind of like after the first factory has been built. And then you look at that industrialization phase, kind of like the in-between, and we see a very small handful of funds operating in that space, maybe $7 billion of dry powder. But there is definitely a gap in there, but I think the companies that are making it through industrialization are incredibly strong and robust companies.
Is that industrialization gap or that kind of middle territory, is that getting easier, smaller, or faster? Or is that roughly as difficult as it was not just 3 years ago, but maybe 5 or 10, Milo?
Yeah, I mean, that is the missing middle that everybody is talking about, right? And so that space is defined as you have built a pilot, it is totally functional, it is working, you have some nascent customer traction, and you are now entering the missing middle. And I think people are getting very creative on how they're navigating that. It's forcing companies to be very capital efficient and laser focused on operations.
Okay, now, Gabriel, before we jumped on today, we were talking about first of a kind, people trying to build factories, and you said that you thought that the current conversation about that was a little bit overblown. So can you please bring that into Milo's point about the missing middle and the difficulty of kind of scaling up factories?
Yeah, absolutely. And I'm going to sort of even back up to something, Schroepfer, that you said just a second or a minute ago. I think people kind of tend to forget that the economy, fundraising, capital investment, venture capital, these are cyclical. You know, booms come, booms go, busts come, and then they go. And, you know, I think a lot of the angst and the panic that some people are feeling and communicating is genuine and legitimate. And some of it is just like they haven't been through one of these before. Like Mike, I was around the .com, the telecom boom. I was working in an optical telecommunications company in 2001 when just like all of our billion-dollar companies went 1/10 of their valuation in the course of a few weeks, right? I was working, in a bank in the, Great Recession in 2007, 2008, where people had been in the industry for 30, 40 years, had never seen anything like that, right? So yeah, this is another one of those cycles. For the missing middle, I think there's some component to that. It's a hard spot to invest. You can lose money quickly doing it. And on the other hand, I think a lot of it comes down to the companies. They have not articulated a clear value proposition. They have not pointed to a really big opportunity that their progress has unlocked. And therefore, there is not missing capital. There is plenty of capital there in many instances. What there is a bid-ask spread. Capital is available. It wants a price that the company is not willing to accept. If the company doesn't want to accept that price, then I'm in those companies. We have to be better at articulating the value proposition. We have to be better at articulating why this saves the customer money, why it is a better product, why it has more value. Those things again that Schroepfer was talking about. So yeah, there's a bit of that. I agree, Milo, but a bit of it's a little bit overblown in my opinion.
So there's two issues here. One is there's a lot of early stage funds, a lot of later stage funds, fewer focused on this, quote, missing middle. But Gabriel, your point is that some of these companies just aren't maybe ready to raise that next tranche of capital. So it's more on the founder's side than the investor side. Is that a fair summation?
I don't say they're not ready. Maybe some of them are not, right? And some of them, they needed more time and more capital to make the progress that creates the value inflection point. But many of us, and I don't want to just say on the founders, it's the company, it's the investors, it's us who are in the company, haven't really thought through what was the demonstration point? What were we working towards? And how does that demonstrate value creation in the future that you can say, hey, if I put money in at this valuation now, next time we need to raise money, it's going to be at a 3x, 5x valuation because we will have de-risked something, we have demonstrated more value. You just have to be laser focused on that. And I think in the easy capital days of 2020, 2021, it was easier to lose sight of that.
Alex, I just want to shout out to like the entrepreneurs out there, because I spent most of my career as an entrepreneur and operator. It's freaking hard. And I know we love to like make it look awesome on TV shows, but even in the best of companies, I spent 16 years at Meta, Facebook. When I joined Facebook in 2008, I spent a lot of time trying to convince people to join Facebook. It was freaking hard. People thought it was a social network, not going to make any money, going to run out of business. And then we did well. And then it was like, oh my God, mobile's going to kill you. It was a nonstop roller coaster of like, oh my God, we're going to die. And everyone thinks we suck, and then we think we're awesome. And then they think we suck again. So for anyone who's been through that roller coaster, it is not fun and it is hard, even in the best of times, even for companies that are now like in the top 10 valued companies in the world, which I was an executive at. Like So I think we just got to acknowledge that. But like at the floor of all of this is like, if you are building a business which at its core has a unique value proposition in the world, you can power through all of those things. And that's what I think separates the companies that are going to like plow through these times and the companies that are going to really struggle.
Milo, I want to make sure we get you in here. Yeah.
Yeah, I would just chime in. I think there is like a bigger theme that's happening here, and that is the reindustrialization theme. And we're on this path for a number of reasons, but I think there are entrepreneurs that see the challenges of the day, which is one, climate change, two, equality for everyone to have good paying jobs, and three, supply chain resiliency. Like we have to be able to have independence. So that these entrepreneurs working on this mission. And so we see this 10x step up in factories getting built in the United States, both large industrial leaders and startups. And without the technology that these founders are bringing to market, we actually wouldn't be able to be cost competitive globally. So the importance that these technologies get into industry is incredibly important. So like we should be leaning in and helping these founders fund these industrial projects, staff them with competent operational leaders, and support them to tell those stories. As you're saying, Gabriel, thinking about how do we convince investors to continue investing?
So,
it's a huge lost opportunity if we do not do that.
I'm trying to put my finger on what we're missing, because I think we all agree that the planet could use some help, and also that there's a lot of really great business opportunities in working in climate tech more broadly. But it seems like there is capital. There are some people working on this missing middle area, and there's a communication issue, but that doesn't seem to be that big of an issue. So are the tensions and the angst, as Gabriel put it, solvable issues for climate tech in the next couple of years? And
I would push back a little bit on the capital structure. I don't think is configured quite correctly. Gabriel, or somebody said it early on. They were saying that, you have these valuations that come from the early side, and then you've got the later stage investors that are looking for a multiple on revenue, and the two just do not meet in the middle. And like the reality is you cannot use equity to fund CapEx build out. Industrial leaders that have great credit are using debt to fund the build out of their gigantic factories. And these startups don't have access to any credit, any kind of debt facility that is in the volume or size that they need to be able to do these large industrial projects.
All right. So Gabriel, off of Milo's point there, interest rates have gone up dramatically. The price of money has gone up. And I bring that up because it makes debt more expensive. We've seen some retreat there thanks to the Fed lately, but has increased capital costs made this missing middle and especially the first of a kind build out that we've talked about more difficult in the last couple of years?
Oh, it's made it more expensive, 100%. We were talking about this I think we were talking about it 12 months ago on this very panel, and we've been talking about it since 2022, when the current down cycle started to happen. But there are tools. I was not saying you have to fund all of these things on equity. I was not saying that at all. There are tools that aren't there. There are large secular tailwinds for many of the sorts of companies that we're talking about. But let's dive a level deeper. Climate tech is not an industrial sector. There is food and ag. There are agricultural companies. There are energy companies that have to do things like build transmission lines, build power plants, build factories to make equipment for those things. There are transportation and mobility companies. I could go through on and on. There are steel and cement companies. Those are not climate tech companies. You are making steel. You are trying to invent a process to make steel. And then on the support side, yes, a startup like Boston Metal does not have the debt capacity that ArcelorMittal has. Okay, obviously true. But there are things that have happened in this country and in Europe and around the globe, like the Bipartisan Infrastructure Law, the CHIPS Act, the Inflation Reduction Act. All of these things provide other mechanisms to get those plants and factories funded. And the boards and the senior management of those companies and the investors have to figure out how to piece these things together. And somebody else said it. The great companies are doing it. they're growing. They're growing through this. They're pushing through this time of, this more challenging capital formation time. But you have to be able to have and articulate a clear value proposition to your customers.
Gabriel, I would agree that the great companies are making it through it, but they are having to be incredibly creative, specific to their industry, right? Like taking out inventory revolvers with SVB, or working on equipment finance, or hopefully they qualify for the IRA, because not all of these companies qualify for the IRA.
Milo,
So
I totally agree. But like back to what Schroepfer was saying earlier, that's being in a startup. It is so freaking hard, right?
But
like,
if we are going to change, if we're going to change the industrial fabric of the United States, we cannot have everybody trying to use this rope bridge to get across, right? Like, we are rebuilding the industrial backbone of the United States right now. Like, we have the tools to do it. It could happen, but we can't have everybody doing these one-off funding strategies.
Okay, so then Milo, what is the recommendation from either yourself or from DCVC to solve that? Is it like, the government putting together a program to offer reduced rate, capital via debt vehicles to startups? Or is there something else that you think would be useful that we could put into effect now?
I definitely don't have the answer. I am
How dare you? Come on,
rope bridge. I've got that one down. I think it's going to be a combination. I think that we're going to have to be creative and thinking about some of our financial tools. MIT has a project going on right now where they're doing deep analysis on how these companies are building their capital stack, looking at the tools that other industries use to do some funding forward for maybe more risky endeavors. Yeah, the answer isn't out there. We don't have it, or we'd be doing it.
Yeah. Mike, your firm definitely focuses on scale. You guys talk about reducing prices through scale. It's called Gigascale. I want to get you to weigh in on this financing issue we're discussing.
Yeah, I have a slightly different view, which is, startups are fundamentally unicorns. Like they are outliers in the industry. So I always struggle in these conversations where we talk about averages and numbers, because like in every industry, it's usually one or two companies that make the difference. Like, what made electric cars 20% of the current market right now? Tesla. Like, without Tesla, we wouldn't be here. And so, we can go industry by industry. What's the one company, that did 10x more space launches than NASA did at its peak with the space shuttle? SpaceX. A ton of other people are trying. One company made it. So I think in many cases, you're looking through this. And yes, financing is hard. CFS, which is a fusion company, has raised $2 billion in equity financing so far, and has a bunch of government financing and others. But part of the challenge here is I'm super in favor of anything that sort of like lowers the floor and raises the ceiling, government grants, programs, etc. But my attitude is a little bit more like I'm looking for those unicorn outlier startups who are going to find a way no matter what the environment is, and they're going to get real creative. Outside the climate tech world, so I have one hat in the tech world, still OpenAI just raised the largest valuation ever a company has ever raised at, $150 million. They raised $6.5 billion of equity financing, another $4 billion in debt, right? For a company that is fundamentally burning cash more than any of my climate tech companies, right? So there's something about the opportunity there that has gotten investors comfortable with investing in a valuation that exceeds the valuation of most companies in the public stock market, right? So I think investors get really creative when you have an opportunity in front of them. And I think this is part of, for example, what makes CFS successful, is they say, look, if we make fusion work, we're going to have the lowest cost in a $2 trillion market. We have basically unlimited demand for the thing that we're going to do. And so take a shot on us, which I think is a similar value proposition you see to others. So that's an extreme example of something that I think is out there. But I think fundamentally the question I'm asking is, how do we find these outlier people, industries, technologies, and then sort of pile in behind them and push?
Yeah, I think I couldn't agree. That was a brilliant articulation, Trev, like just spot on. And I think it comes back to why there's this capital gap, is because all those Series A investors are looking for that. And in some way, it's more fun, it's more exciting, but you have to have a lot of shots on goal, right? Like to the point of it, in 2010, there were probably 100 battery companies or 50 battery companies. And if you walk the halls of the ARPA-E show in 2010 or 2011, like you were tripping over the next best, lithium ion, every single flavor of, lithium ion, alternative chemistries. There were sodium transport batteries back then. There wasn't even, any of the long duration storage chemistries hadn't really even been contemplated yet because that kind of opportunity hadn't been identified. And yeah, less than half a dozen of those are surviving, and still maybe only a couple of them are going to be big companies. That's the way this industry goes. I fully agree with what you just said.
Yeah, I think a trail of corpses is kind of the startup game because it's a lot of ideas. Not all of them are going to pan out. The way that I was thinking about this, though, before we all got together was through just the lens of carbon, because I think climate tech, as we said, can be everything from power generation to storage to farming, et cetera. But I kind of split things up into two different buckets, Gabriel, which is removal of carbon and mitigation of future emissions. And your firm, Prelude, has backed Ebb Carbon, which does removal, and Boston Metal, which does metal production sans carbon emissions. So when you look ahead at the next maybe 3 or 5 years of investing you're going to do, are you going to focus more on startups that are working to actually remove carbon from the climate, or just to mitigate additional carbon being released from our industrial base?
We're not going to do either of those things. We're going to keep doing all of the above, right? Like, we're going to keep looking for great entrepreneurs that have a really compelling technology that, if they succeed on it, unlocks a huge opportunity. There's this paradigm of you're looking for something that's really hard, that if you solve it, it's a huge unlock for a really big, massive opportunity. And that can be technical, business innovation. It can be a combination of those things. We're going to keep looking at it. We invest in food and ag, energy, mobility, manufacturing and industrials, built environment, carbon management, to your point, and we invest in compute. We're not going to stop looking in any of those sectors. And hopefully we're going to come across, a few more sectors. Somebody's going to walk in our door and say, no, you need to think about this. I don't know what that is, but you need to think about this, because this is a huge way to mitigate a whole bunch of emissions. And we're going to say, wow, I hadn't thought of that before, but let's do it. And I can think of, in 2013 or 12 or something like that, fashion and the circular economy and reducing, textile manufacturing and waste felt like a little bit of a corner case because nobody was really talking about it from a climate perspective back then. And now we have a bunch of investments in that sector. Fast forward 10 years and it's obvious, but it wasn't obvious 10, 15 years ago.
All right. So, Milo, picking up on Gabriel's point that we can think about climate tech through the lens of a lot of different industries, is there an area of what is considered climate tech that DCVC is just not interested in moving forward? And especially, I'm curious if there's anything you learned in the last 2 or 3 years that led to that particular decision at the firm level.
We look at it all. We feel like, we're looking for companies that are going to redefine industries, and there is going to be a bunch that come across, and we're just excited to see all those companies. There's nothing we're not looking at.
And then Mike, over to you. I presume it's going to be the same answer, but anything that your firm is looking to not invest in the near future?
Well, I would similarly say never, because an entrepreneur can always surprise me. And there's been plenty of markets where I'm like, that market's terrible. And then the right company comes by and like, oh, I was wrong. And so I'm always willing to be wrong. I will say that certain markets are more established than others, so it's harder to start a new company. I think it would be very hard to start an electric car company right now. I think battery manufacturing is a very hard business to be in because you've got scaled companies out there that you've got to sort of overcome. And I think you've got a lot of other greenfield applications out there. If you can, if you can put hundreds of megawatts or a gigawatt of clean, firm power on the grid in 28 to 30, oh my gosh, come talk to me. There's an unlimited demand, people lining up at the door to buy your product. Now, there's a lot of challenges there. There's only a couple solutions. There's geothermal, which I'm very excited about. There's fission. There's fusion won't make it in time for that. There's offshore power. So a lot of ideas there. But I think that's a market where you've got incredible tailwinds and not enough solutions out there. You've got other markets like EVs where it's a whole bunch of companies making EVs now. So you've really got to try hard to differentiate.
No, I was just going to say, you heard some articulation here of, you have this 2x2 matrix, everybody's favorite, and you have ideas that are either closely held or loosely held, and closely examined or loosely examined. I don't do this, I don't succeed, but I like to have a lot of closely examined and loosely held beliefs about what's going to work, right? if you're loosely examined and closely held, man, that's really bad. But you can really have an open mind, but really dig deep and be willing to be corrected. Fantastic things happen. I think the best entrepreneurs have that mindset as well. Although actually some of them have really closely held beliefs. They get that tunnel vision and they succeed no matter what. Maybe I'm just wrong about that for the entrepreneur.
Well, no, I think there's many ways to succeed. But one thing that people have been talking a lot about when it comes to the power generation side of all this is just how AI is driving enormous amounts of power demands around the world. Companies like Fervo Energy, Exawatt, there's a lot of companies that are doing cool things, but I'm curious if you guys are seeing a lot more founders step up because now I think it's pretty well understood that data centers of the future will need so much more power than we currently produce. Is that bringing in a new cohort or crop of founders that want to go after that problem? And Milo, let's start with you.
The answer is yes. I think the creative ones see these trends happening before they happen, right? And a lot of founders are already working in the space, right? A lot of these founders have their PhD or advanced degrees, postdocs in these areas. So they've been working on these topics for a decade, right? They already knew that silicon was going to be a climate technology company. They were just waiting for people to catch up with them and get there, right? So I think those people have always been there. They've always been doing amazing things. And now they get the limelight of being visionary on the forefront of tech.
Okay, that's encouraging because it does seem like we have an enormous gap in our generation abilities. And that's why I've been excited to see both nuclear power and, back to Mike's point, fusion. Although fusion, Mike, 10 years still probably from now?
I think nobody credible thinks it'll be commercially ready until the 2030s, mid 2030s probably. That's even a shot. I think it was one of these binary things. When it hits, it'll be completely transformational, but it's hard to pin down exactly when. And I would just double down on what Milo said. I think what you see is, it's hard to start a geothermal company today. You had to have been working on it for a while and see that power is like what underlies everything. And even before AI and data centers, if you look at power use in the United States, most of it is not electricity. It's heat for industrial, it's heat for heating homes and buildings, it's transportation. And so you'd say like, we're going to need a whole bunch of different ways to make really, really cheap heat and electrons. And so I think people have been banging on that door. I think in terms of headwinds, tailwinds, as I said, I like tailwinds where it's like, oh my gosh, if I have a product, there are customers. And, energy generation is one. Energy storage is another one. We have such short memories. If 10 years ago, I'm like, I have this breakthrough technology which lets me store energy on the grid. Everyone would be like, so? Who cares? I got a big gas tank next to my gas power plant pipeline. What do I need storage for? That thing's really cheap. Now everyone would be like, well, how much can you deliver tomorrow? Basically, because solar has gotten here and it is causing very cheap power for a number of hours during the day that we basically waste. And if I can store it and resell it at a cheap price, I got a great business. So this is part of why I'm in this now. And I'm so excited is I think these disruptions happen and it's often the second bang effects. So people get excited about platform shifts like mobile, for example, mobile phones. No new companies really got created that made money on the platform. It was Apple, Samsung, and Google that made money on the phone itself. But because of the mobile phone, you had Uber, Instacart, Facebook, a whole variety of other apps that just couldn't have existed. What we have right now is a secular disruption of our power generation through wind and solar, moving us from a static grid to a dynamic grid. And I think it's going to create a whole bunch of secondary opportunities for storage, arbitrage, new power companies, a whole bunch of things, which is really, really, really exciting.
All right, we only have a couple of minutes yet, and I haven't given you guys each a chance to be talking your book. So let's quickly wrap with which portfolio company do you think is going to have the biggest impact, positive impact on our climate in the next 5 years? And let's just do Milo first.
We have two amazing companies in our portfolio right now. We've got Fervo, geothermal, which is just on the brink of blowing it up, doing amazing. And we've got 12 that makes SAF, sustainable aviation fuel. And they are just killing it. They just raised $645 million to expand their facility. So it's incredible.
And then Gabriel, over to you. The investment that you have, do you think is going to have the biggest climate impact in the next 3 or 5 years?
I love all my children, Alex. That's not a fair question. On the theme of massive industrial disruption, I think Boston Metal has a real amazing shot on goal to produce zero carbon steel in the long run. I think both Koloma and electric hydrogen are reducing the costs of hydrogen, which can solve so many problems with two completely different approaches to that. Warm energy is not only enabling the integration of solar and wind into firm dispatchable power, but I think it's going to be an energy transformation company. It's going to be a generational company. Pivot Bio has disrupted, eliminated the need to use the Haber-Bosch process, or at least diminish the need for the Haber-Bosch process. What's the most impactful invention of the 20th century? It might be Haber-Bosch, and Pivot might be the first tech that sort of gets us a little bit away from that. So I could just keep on going and going, but I'll stop there.
All right.
I love you all.
Don't email him. If you're mad at somebody, you can get mad at me. Mike, same question over to you. And why is it Arbor in the case of Gigascale Capital?
Say again, what was the last question?
I thought Arbor was the coolest company that you guys have in your portfolio. So I was joking.
Well, I was going to mention one of them because talk about clean, firm power. This is a crazy idea coming. A bunch of SpaceX engineers said we build a next generation biofuel plant and oxygen and wood go in, clean power, water, pure CO2 come out, which you can sequester. And as a result, they signed a deal with Microsoft, which is a 5 megawatt power deal. So they provide clean, firm power and 25,000 tons of carbon removal from the same plant. Usually you burn a bunch of power to sequester carbon. This you get power as a side effect of sequestering carbon. So that to me is like fundamental technological disruption, power and carbon sequestration. I'm going to pick two others just because they're two other industries. Chemicals is something people don't talk about because we don't see it. It is one of the largest emitters out there. We've got a company called Dioxycle, which is basically figuring out a way to make green ethylene, which is a commodity chemical. It's one of the most made molecules on Earth. If you've had a yogurt cup, in that yogurt cup is ethylene. It's made with a really dirty, nasty fossil fuel process now. They do it in a clean way. And the kicker is it's cheaper. So at scale, they're going to just be cheaper than the other versions of doing it. So that's the kind of company that I love. And then the third, just in a totally different direction, is something consumers would understand, which is called The Mill. It's a home composting device. The thing about it, if you talk to someone who has one, they won't shut up about it. They're going to tell all that they're going to be the person at the party go, do you have a mill? Can I tell you about mine? Can I show it? People love the product because it makes their life better. I would joke like, who enjoys taking out your trash? Nobody. We make taking out your trash a lot less frequent, a lot less messy and smelly. And like, oh, and by the way, they've removed about 2 million tons-ish getting to of food waste from landfills. That creates methane.
Thanks for bringing up mill, Mike, because
it's just like, it's a like on the back of people, like I buy it because I love it, right? And then, by the way, I'm helping the climate. So, and I think there's just so many businesses like I'm so excited.
Well, I got to say, everybody, prepping for this, I was a little bit concerned. The numbers seem to be a little bit rough, so I wanted to make sure we talked about that. But just listening to the back half of this conversation and the enthusiasm for solutions and people who are building them, I have to say I'm feeling a little bit more optimistic. So thank you all, each of you, for making me feel better. Milo, Mike, Gabriel, thank you for your time. And we'll do this again next year, and we'll have even better news for everyone. But in the meantime, SOSV, back to you.